Mike Giordano, our financial advisor with Williams Wealth Management, joins us on this Wednesday. We're talking about the debt ceiling. Now, the Treasury Secretary says June 1st is the earliest date that the U.S. might not have to have money to pay the country's bills. And so we're looking at maybe taking on more debt or the country's first ever default. Mike, people can kind of hear debt ceiling in politics and da-da-da, but this matters for every American, doesn't it?
Oh, sure. I mean, it's the government and all the government's tentacles, they reach into everybody's pockets, right? Whether you're a taxpayer, you're an investor, whether you work for the government or you're a government contractor, everybody's affected by this because the tentacles reach into all parts of the economic machine. And so this is a big deal in any situation, but right now the economy's had a lot of pressure exerted on it. The Federal Reserve is hiked rates by 5% over the last year, so it's put a lot of pressure, a lot of stress on the economy. And you know, when you're under stress or you're under pressure, sometimes it doesn't take that much just to blow your fuse, right? It's the straw that breaks the camel's back. And so a situation like this could be the straw that breaks the camel's back on the overall economy. The economy's been so resilient, and so you don't really want any of these types of situations where any parts of the economic machine are disrupted in any way.
Okay, so politics aside, what do investors need to expect? And is Wall Street reacting one way or the other yet?
So far, Wall Street is saying, don't test our patience, but we are patient and we're calm. The expectations are that we know how politics plays out. There's going to be a whole lot of back and forth, but eventually we think a deal is going to be put together. And so we're not overly concerned yet. But as you pointed out, the X date's 2 weeks away. Today we had some nice optimistic talk from both sides, and so the markets were very buoyed by that. But if we go another week and a half, and we don't have any kind of progress or we get some negative talk, the markets will start to have more of a spasm. And the question is, we haven't seen a default before. So even getting close to it, like we did in 2011, the markets are going to be very volatile in both ways.
Okay, and then as an individual, so a default, you can't have that as a nation, but people like the safety net of their treasury bonds, especially retirees, people on fixed incomes, what do they need to be expecting?
Yeah, so you would think if the government defaulted on its bonds that it would be really bad for U.S. Treasuries. We only have one instance where we got close to it, 2011, right? And the Treasuries actually did well in that situation.
Oh, wow.
Mostly because people were like, well, they're still the safest thing. They might not be as safe as we thought they were a couple of weeks ago, but they're still safer than other asset classes. But that's only one instance. You don't want to ever bank a strategy on one instance. One thing you could definitely bet on is that you would probably get that volatility, just like you would in stocks and other assets. You would get volatility in bonds, and so it's not a good thing, especially coming off of last year where conservative investors, people that own treasuries, they got hit really hard last year as interest rates floated up. So this would be kind of like a 1-2 punch.
Okay. Call your local politician and tell them that you want to keep negotiating.
Yes.
Mike Giordano with Williams Wealth Management. We always appreciate having you here.